Guys, this is an ETF that absolutely can beat the S&P 500 over long periods of time. I'm going to show you why fundamentally it makes sense. Now, let's go over these two real quick. The first one is SPY, VOO, whatever. These are both low-cost ETFs that follow the S&P 500. The reason I love them, S&P 500 adds and removes companies based on certain parameters every year. You buy this, you don't have to think about it. You're going to match the market. 98% of investors are probably never going to even match the market. You hire a high-priced financial manager to do things for you. They're going to make the same emotional mistakes that everybody makes. Invest in these. 500 biggest companies out there, profitable, and all large caps, basically, right? Okay. Now, the other ETF that over the last 23 years has beaten the S&P 500, VTI, the Vanguard Total Market Index. This has 3,700 plus companies versus 500. So you might sit there and say, well, I don't want more diversity. But the difference is large, medium, and small cap. Now, why does this matter? Guys, let's think about it this way. If you have a company that has $100 billion in revenue and $10 billion in profit versus another company that has $1 billion in revenue and $100 million in profit, which one could double faster? Small cap. The $1 billion revenue, $100 million company. That's why these two should, over time, add more return to this. Because they are able to grow at a faster clip. Some of these will become medium and large caps. Some of the mediums become large caps. Some of these will go to zero. But overall, you don't have to think about it. VTI will get you in and out of these things over long periods of time. Now, there is a little bit of trick to this. It doesn't always beat, but I think there's good reasons why. So let me pull up the chart. First off, this is the chart over the last 10 years. In orange here is actually the S&P 500. In purple is the Vanguard Total Market Index. Now, before you say, well, this isn't including dividends. The dividends are 1.3 versus like 1.25%. They're negligible. Over the last 10 years, the S&P is beaten by a total of 14%, which is roughly 1% per year. Now remember, 1% per year is a big difference. S&P 500 has beaten this. But look at this. It took until about 2021 for that to happen. And a little bit over here too. Why? Big S&P boom. You've also heard lately, small cap and mid cap have not been doing well. In this market especially, what has done very well? The very large companies, the Magnificent Seven. So when you have 500 companies and the top 7 are carrying the entire index versus 3,700 companies where the top 7 are carrying the index, which one's going to have a bigger impact on price performance? Of course, the 500 companies, which is here in orange, the S&P 500. Let's go back out to 2001 when both these started. Boom. Now it's Vanguard on top, 344.9% versus 297.3% gain for the S&P. Again, not including dividends. Dividends are another 1.5, whatever percent on top of that. What's the difference? VTI, 6.7% per year. S&P, 6.17% per year. This shows you the power of compounding. This mere 0.5% difference over 23 years has meant 50% more money from your initial investment. That doesn't include if you just kept dollar cost averaging along the way. From day one, going back to here, the VTI has basically been above the S&P the entire time. But over a 10-year period, the S&P is beaten. But again, I think it's fully understandable why that is. If I were to guess, my guess is that for the next 10 years, VTI will beat the S&P because of small cap and mid caps poor performance as of late and the 7 Magnificent 7 stocks dominating over the previous couple of years. Now, guys, you pull up this video for one reason. You want to make more money. And as we all know, you are going to end up like the people that you surround yourself with. And unfortunately, in investing, you're not around anybody. You're all alone. But that is why I created our community. I spent millions of dollars creating our software in a community. Thousands of like-minded investors in here that I get to talk to every single day, criticize my ideas, ask for me to bounce out my ideas off of them. I criticize their ideas. It's a safe place to make investment decisions and talk about things. And one of the things I'm going to go through here is one of our tools to show you the difference of that 0.6% over years and years and years in your retirement. So guys, if you're interested in being around like-minded investors that can help you sleep better at night and make better financial decisions, because that's all we really care about, go to everythingmoney.com or click the link below. $7 for 7 days. It's a great promo we have, so go check it out. Now, to show you the difference and how much 0.6% matters over a 40 or 45-year period, let's take a look at this. Let's say you're 30 right now, and you're going to retire at the age of, well, let's just do 35 years, 65. You have 100,000 in savings today, and you're saving 10,000 a year. You're going to increase your savings by 4% a year, and you're going to get, let's call it 9.5% return. So usually it's 9 to 10%. Let's pick 9.5 in VTI. We'll just assume that. And during retirement, you'll do 6% because you want to be more conservative. You're going to live to 100, and inflation is 3.5%. And you currently make 75,000 a year, and you want to live on the same income over that time. Now, I ran through this, and if you join our community, there's a video to explain how to do this. But I basically am sitting there saying you're 30, retiring at 65, living to 100. Do you have enough? 9.5% returns. You have enough. Immediately, yes. You retire at 65 with $6.6 million, which is equivalent to $2 million today, and you pass away with $6 million, equivalent to $550,000 today. So you never run out of money. Now, let's change this to just 0.5% lower per year. You do not have enough to retire. Ironically, though, all you need is $20 more per year. That's what's so great about the software. It tells you exactly how much you need to retire. $20 more per year. Now, at the age of 65, you have 5.8 million versus a 6-some million. It's almost $1 million difference in value. That's the difference by that 0.5%. They add up to real dollars over long periods of time. Now, that's not all, guys. You got to remember, one thing I've always talked about is tech. There's another ETF called QQQ. It's the NASDAQ 100. Guys, I'm going to tell you, it's a very overpriced index right now. Does that mean you should avoid it? No. What it means is pick the right time to invest. Here's why I like tech so much. 100 years ago, if you had a business, you had to build a factory. You had to have a lot of employees. In order to grow the business, to build more factories, it was a very capital-intensive business. You had to invest a lot to get a little return. With tech nowadays, it's much easier to make a great quality product that can be replicated over and over with high margins. And once you've created the product, you have to maintain it. So it's easier to generate high rates of return on technology. QQQ is the kind of fund that over long periods of time can make a lot of money and vastly outperform the market. Let me show you exactly how. So here on QQQ, this is taking QQQ all the way back to when it was founded. Now look, guys, the tech bubble occurred here and it vastly outperformed. And then it plummeted, fell by 83%, and for a long time was underperforming the S&P. This is back in 08 and 09 right here. So it's not even a tech bubble here. And look at the growth in QQQ. Now, do I think this is sustainable? No. But if you are able to make the purchases when things make sense, or even when things are reasonable, you're probably going to outperform. And you have to think about what's the next tech company. Because as they get larger and larger, QQQ will naturally invest in them. Guys, I love picking individual stocks. I'm going to do this as well. Because I look at this as a way of me not having to think about what's the next big thing. I'm just going to ride a good index for a long time. And these returns are very big difference. Let me show you exactly the difference here between 758% over that time period versus 297.5%. The difference here, guys, is QQQ, 8.97% per year, not including dividends. SPY, 5.7% per year, not including dividends. And this also leads to another example, guys. 1999 was the middle of that big, huge, massive bull market. And look at the S&P since then, 5.7%. Not much. That's why I'm telling everybody, be cautious now. But even at that tech time, the tech market soared. And even with the collapse of 83%, it still made 9% per year since then. So if you can withstand a lot of fluctuations, because tech will have that fluctuation, and if you can be patient and wait for the better times to buy, when the gap between tech and normal isn't as bad, you can make a lot of extra money in alpha, which is the difference between S&P and total return. You can really do that with QQQ. Now, guys, if you want to see the 13 companies I currently have in my portfolio, click the next video, and don't forget to join our community to have a better peace of mind and surround yourself by better people at the link below.